Hello, everyone, and welcome to Intermediate Accounting 2, Chapter 20, Part 2, the Lessor Accounting. So in the last video in Part 1, we went through the Leases accounting and journal entries. So the lessee is the company that's renting or leasing the asset. And in this video, we're going to go through the Lessor accounting, which is the owner of the asset that's leasing out the asset. Okay, so just to recap the first three topics we did in part one video. We went through on the leasee side, whether it's an operating or capital lease for ASPE, then the journal entries for operating leases and capital leases for ASPE, and then the journal entries for the leases under IFRS 16. In this video, we're going to go through the lessor leases and do the journal entries for the lessor, and then go through sales and leasebacks. So just a recap from the previous video, for capital lease in ASPE, there's three tests or three criteria you have to go through. That's the transfer of ownership test, so determining whether or not the lessee obtains ownership of the asset at the end of the lease term, either with a bargain purchase option or automatic transfer. The economic life test, determining whether the lease term is at least 75% of the economic life of the asset. And then the investment recovery test, determining or seeing if the present value of the minimum lease payments is at least 90% of the fair value of the asset. Okay. So in lessor accounting, there are three types of leases. So under ASPE, it could be an operating lease, which functions very similar to an operating lease for the lessee. It could be a sales type lease, or it could be a direct financing lease. And we'll go through what those mean in a little bit. In IFRS, the types of leases are the same, just the terminology is different. So operating lease is operating lease. What ASPE calls a sales type lease, IFRS calls a manufacturer or dealer lease. And what ASPE calls a direct financing lease, IFRS calls a finance lease. Okay, they mean the same thing, it's just different terminology that both standards are using. All right, so for ASPE, if a lease is classified as an operating lease for the lessee, then it's automatically an operating lease for the lessor as well. So if you go through those three criteria, the three tests, and none of those tests are met, then that means it's an operating lease for the lessee, and that also means it's an operating lease for the lessor. Okay, so we still have, even though we're the lessor, we would still go through those three tests, the three criteria under ASPE to determine if something's a capital lease, and if none of those are met, then this is an operating lease for the lessor. If it's classified as a capital lease for the lessee, okay, so you go through those three tests or the three criteria, and at least one of those criteria are met, then it's a capital lease for the lessee. Then it needs to meet two additional criteria in order for it to be either a sales type lease or a direct finance lease for the lessor. Okay, so kind of like if you go through and think about a decision tree and say, okay, so the first question would be capital lease. I don't think I have enough room to do this here, but capital lease for lessee. So you would either say yes or no. Okay. So if it's no, then automatically it's an operating lease for the lessor. If it is a capital lease for the lessee, there are two other criteria you have to go through. And if both, I'll mention what the two criteria are, but if both these criteria are met, then it's either a sales type lease, or a direct financing lease for the lessor. And I'll explain how you determine the difference between these two in a bit. So the two extra criteria you have to meet in order for something to be either a sales type lease or direct financing lease is, the first one is the credit risk associated with the lease normal when compared to the risk of similar collection of receivables. So basically it's asking, so you have all these accounts receivables on your books. Is the risk associated with this lease, getting the money for this lease, similar to getting the money from your other accounts receivables? So if all your other accounts receivables, there's a 5% chance of uncollectible. For this lease, is there, around a 5% chance uncollectible? So is it kind of within the range of the similar receivables, or is there like a 30% chance that it's not collectible? Okay, so if the credit risk is normal, then this criteria has been met. The second one, can the amounts of any unreimbursable costs that are likely to be incurred by the lessor be reasonably estimated? Okay, so if there are some costs that the lessor has to assume, can those amounts be reasonably estimated? So in the last video, we were talking about who pays for maintenance, who pays for insurance, who pays for property tax. If the lessor has to pay for these, can those amounts be reasonably estimated? So property tax, if the lessor pays the property tax, can that be reasonably estimated? Or if they pay for maintenance or insurance, can the lessor reasonably estimate this? Okay. So if both those are yes, or both those criteria are met, then it's going to be a sales type lease. If either one of those are no, sorry, sales type lease or direct financing. If either of them are no, so either this one's no, or this one's no, or they're both no, then it would be operating lease. All right, so in order for a lease for the lessor to be either a sales type or direct financing lease, it has to meet the criteria for capital lease. So it needs to meet at least one of the criteria for capital lease, and then it needs to meet these two additional criteria as well, both of these additional criteria. If it doesn't meet any one of those, then it would be an operating lease for the lessor. IFRS is a little bit different in determining whether something is a either operating lease or a manufacturer dealer or a finance lease. Okay, so IFRS goes through 4 criteria in order to determine if something's going to be an operating or sales type, sorry, not sales type, manufacturer dealer or finance lease. Okay, so the 4 criteria that I will be discussing, if none of the criteria are met, okay, so if none met, this is going to be an operating lease for the lessor. If at least one met, then this is going to be either a manufacturer dealer lease, or a finance lease. Okay, and I'll explain the differences between those two in a bit. So first criteria is there a reasonable assurance that the leasee will obtain ownership of the leased property at the end of the lease term? So this is similar to IFRS, sorry, to ASPE, the transfer of ownership test. So here you're looking for a bargain purchase option, or you're looking for an automatic transfer, just like the ASPE criteria. So the first criteria is very similar to the ASPE criteria. So is the second criteria. The lease term is for a major part of the economic life of the asset. So major part, ASPE has defined major part as 75% or more. So we can use kind of the same, the guidelines. So IFRS doesn't have guidelines in addition to what major part is, or they don't have they don't define this. So we can look to ASPE and use the similar guidelines. So lease term has to be at least 75% of the economic life of the asset. And then 3, the leasee allows the lessor to recover substantially all of its investment and a return on investment. Okay, so this is similar to ASPE criteria 2. Looking at are the minimum lease payments substantially all of the fair value of the asset? IFRS doesn't have guidelines on how much, what percentage, but we'll use the same percentages as ASPE, and we'll use 90%. So the PV has to be at least 90% of the fair value. The last criteria is the only one that's different from ASPE because ASPE only has 3 criteria. So the last one is that the leased asset is so specialized without major modification, they're used only to the leasee. So what this means that is the asset so specialized that only the leasee could use the asset without major modification? So if anybody else was to use the asset, they would have to be made a major modification on it. So for example, if a company is leasing a machine, but that machine has to be fixated to the ground, to the factory floor, then that would be a specialized asset. And other companies can use the asset only with major modification, only if they get it off the ground, right? If they have to fixate it to the ground, if another company wanted to use that, they'd have to modify it in order to get it off the ground. So if one of these criteria are met, then it's a manufacturer or finance lease. If none of these criteria are met, then it's an operating lease for the lessor. Okay. So how do we determine the difference between a sales type or manufacturer dealer lease and a finance or direct financing lease? Remember, this term, like a sales type lease and a manufacturer dealer lease, are the same thing. Just ASPE uses sales type, IFRS uses the word manufacturer dealer. Same thing with direct finance lease is the ASPE terminology. Finance lease is the IFRS terminology, but it means the same thing. All right, so if you go through the criteria and you know that at least one of those criteria are met, it has to be either sales type financial manufacturer dealer or direct financing finance lease. So how you determine whether it's one or the other, a sales type or manufacturer dealer lease, this is when the rental amount includes a recovery of the dealer's profit as well as an asset cost. So if you think about, if you look at manufacturer dealer lease, so that is a company is manufacturing a product or an asset and then leasing it out. So they're the ones that manufacture it. It goes into their inventory and then they lease it out. So this is a way to market their products. So if if there's a brand new car out there, but people don't want to just buy it right off the bat because they want to test it out first, the manufacturer might allow there to be a lease, and this way if the car is being driven around, other people will see it and maybe other people would want to buy it. Okay, so the profit here is the difference between the lessor's cost and the fair value of the leased asset. So the lessor's cost is going to be how much can they make from it. Okay, so the lessor's cost is going to be how much they made the asset for. So it's like whatever the inventory amount is, right? That's the lessor's cost. So in a sales type or manufacturer dealer lease, the lessor's cost is going to be less than the fair value of the asset, because you're not going to, if you have inventory, your inventory is not the same as your sale price, right? Your inventory is usually lower than your sale price, so you can make a profit. So your lessor's cost in this case is going to be less than the fair value of the asset. And that's how you would know that it's a sales type or manufacturer dealer lease. So you'd have to compare the lessor's cost with the fair value of the asset. And if the lessor's cost is lower than the fair value, then this is a sales type or manufacturer dealer lease. For a direct financing or finance lease, these are lease finance companies. So what this means is that it's a company that buys an asset and then leases it out. So they don't make the asset, they don't manufacture the asset, they just buy the asset and lease it out. Sometimes these companies buy specific assets that lessees have asked them to acquire. So if a lessee knows that they want to rent some particular machinery, they'll go to these lease financing companies and say, hey, I want to lease this machinery, can you go buy it so I can lease it? Okay, so sometimes they do that as well. So in this case, if they're buying the asset and then leasing it out, their lesser cost, the lesser cost is going to be how much they're going to buy the asset for. So they probably are going to be buying the asset for the fair value amount. Okay, so the lessor's cost is going to be equal to the fair value of the asset, because they're going to go out and buy the asset first at the fair value amount and then lease it out. Okay, so that's how you know the difference between a sales type or manufacturer dealer lease and a direct financing finance lease. So look at the lessor cost, compare it to the fair value, determine which one of these it is. All right, so since we've gone through all that criteria now, let's do question 1, part A. So if you go into your Excel and go to chapter 20, part 2, class exercises, we have this, this exercise here, similar setup as the last video. We have the inception date, lease beginning date, payments of 20,066. We have a bargain purchase option of 4,500, lease term, economic life, the lessor's cost. So this is something that was added. So this is a lessor's cost, 60,000, fair value, lessor's rate, leasee's rate. Okay. So it says the collectability of lease payments is reasonably predictable. There are no important uncertainties about costs that have not been incurred by the lessor. Leasee assumes responsibility of all executory costs, and they both follow ASPE. So this time, we're going to discuss the nature of this lease to Herbert Corporation, which is the lessor. Okay, so you can pause this video now and do part A, and then unpause the video when you're done doing part A to see if, to look at the take up and see if you did it correctly. All right, so let's take this up. We need to figure out the nature of the lease to the lessor. So what we first have to do, this is ASPE. So if we go back to showing you the slides, ASPE. So if it's an operating lease for the leasee, it's an operating lease for the lessor. If it's a capital lease for the leasee, we have to go through these 2 extra criteria to determine if this is either operating lease or something else, or sales type or direct financing. All right, so we first have to go through the capital lease criteria in order to find out what type of lease this is for the leasee. So it's the same thing, transfer of ownership test. So is there a transfer of ownership? Will the leasee gain ownership of the asset at the end of the lease term? Well, if there is a bargain purchase option, then that means the leasee can purchase this asset for an amount significantly lower than fair value. So if they can do that, then they probably will, and they'll probably buy the asset. So yes, there would be a transfer of ownership. There is a bargain purchase option. Make sure you're always explaining why something is yes or no. The economic life test, what you do is you take your lease term and divide it by the economic life of the asset. 5 divided by 10 is 50%, and compare that to the 75%. So it's lower than 75%, so 50% is less than 75%, and therefore the answer is no, this criteria has not been met. The next criteria is the investment recovery test. In order to do this investment recovery test, we have to do the present value calculation. So we have to do the present value of this 20,066. So I can just do that up here again. So you can do PV equals if you want to do it on your Excel, or you can do it in your calculator. So the rate for ASPE, we're going to use the lower of either the lessor's rate or the leasee's rate. So in this case, the lower is the lessor's rate. Number of periods, we have annual lease payments every year for 5 years. So number of periods is 5. PMT, 20,066. This doesn't include any maintenance or insurance or property tax, so we don't have to deduct anything from that. Future value, we have a bargain purchase, so that's going to be our future value. And it says lease payments are due at the beginning. So we have beginning mode, which is 1. So if we do that, we get $88,000 as our present value. And to determine if it meets the investment recovery test, we're going to divide this by our fair value. So the fair value of our asset is 88,000, which means it's 100%. So it just has to be higher than 90%, which it is. So therefore, this criteria has been met. Since 2 criteria have been met out of the 3, and we only really needed 1 to be met, then this is a capital lease for the leasee. So I'm just going to add this is a capital lease for the leasee, as 2 out of the 3 criteria have been met. And then this 100%, let's say greater than 90%, just to show that yes, it's met because it's greater than 90%. All right, so we know that this is a capital lease for the leasee, right? So if it's a capital lease for the leasee, we need to go through these 2 extra criteria to determine if this is either a sales type or direct financing lease, or if none of the criteria are met, is it an operating lease? So is the credit risk associated with the lease normal when compared to the risk of other collection of other receivables? And can the amount of any unreimbursable costs incurred by the lessor be reasonably estimated? So let's take a look at the case facts that we have here. So it says the collectability of lease payments is reasonably predictable. There are reasonably predictable. So that means that we can probably predict that we're going to get this 20,000. There's no risk involved if they're reasonably predictable. So is the credit risk associated with the lease normal? Yes. I just said see rows 16 and 17 explaining this. So I would just probably copy this and say, yes, they are reasonably predictable. And the next one, are unreimbursable costs reasonably estimated? It says here, there are no important uncertainties about the costs that have not yet been incurred by the lessor. Okay, so there's no uncertainties around the costs that are going to be incurred by the lessor, which means that they don't have any surprises. So I think they can be reasonably estimated. So no important uncertainties about costs that have not been incurred by the lessor. So if there's no uncertainty around it, then I'm assuming that it could be reasonably estimated. All right, so yes, and it's a capital lease. So therefore, because this is a capital lease for the leasee, that means that it's either a sales type lease or a direct financing lease for the lessor. So to determine whether it's a sales type or a direct financing lease for the lessor, we need to compare the lessor's cost to the fair value of the asset. If the lessor's cost is lower than the fair value of the asset, then it's a sales type lease. If the lessor's cost is equal to the fair value of the asset, then it's a direct finance lease. So in this case, lessor's cost is 60,000, fair value is 88,000, which means the lessor's cost is lower than the fair value of the asset, and therefore it is a sales type lease. All right, so that's the final step. So a few more steps involved for the lessor than for the leasee under ASPE. So you want to make sure you go through each one. So go through the 3 tests for the leasee, then go through the 2 other tests for the lessor, and then compare the lessor's cost to the fair value of the asset. Okay, so this is a sales type lease. All right, so now that we know how to determine each one, now let's go to the journal entries. Okay. Journal entry for an operating lease. So if the lessor's lease is an operating lease, then the journal entries are pretty straightforward, similar to an operating lease for the leasee, just switched around now because we're debiting cash this time because we're the lessor, so we're getting cash. So we're going to debit cash, and we're going to credit our lease revenue or rent revenue or rent income. Oops. Okay, so lease or rent income revenue. That's going to be whatever the amount is. Okay, so that's all you would do. So you would just debit your cash and credit your rent revenue. So opposite of what the leasee is going to be doing. So straightforward journal entry for operating lease. For sales type or manufacturer dealer lease, I split up these entries in 2. So at the inception of the lease, the first day of the lease, so a manufacturer dealer lease, like I said, it's a manufacturer that makes inventory and then leases it out. So the way that this journal entry is set up is that we're going to pretend that we sold the asset. And instead of having an accounts receivable, when we sell the asset, we're going to set up a lease receivable. Okay, so instead of accounts receivable, we will be setting up a lease receivable. So we're going to debit lease receivable, we're going to credit sales revenue. I'll explain what we do with the unearned interest income in a second. We're going to debit cost of goods sold, credit inventory. So we're going to take this out of our inventory just like we sold it. So all these two journal entries are just like you would have sold an asset, except there's this unearned interest income, which I'll explain in a second. Okay. So your lease receivable, that amount is going to be your gross lease payment, the gross lease payment that you're going to get. Okay, so this is your gross lease payment, so your total. So for the full 5 years, your total lease payment that you're going to get. So if you have a $10,000 lease payment every year for 5 years, that's going to be $50,000. You're also going to add any residual value, whether it's guaranteed or non-guaranteed. So both guaranteed and non-guaranteed residual value. And you're going to add any bargain purchase option that's here. Okay. So this is the total of all the money that you're going to get throughout the years of the lease. So the total of all your lease payments plus any residual value plus the bargain purchase option if you have that. Your sales revenue, if you're going to sell this asset, you would have done it at the fair value amount. So your sales revenue is the fair value of the asset. Your cost of goods sold is the lessor's cost. So we said the lessor's cost would be the inventory amount. And obviously same thing here for the inventory, lessor cost. This unearned interest income is basically something that's going to bring your lease receivable to its present value. So lease receivable on the balance sheet, so if we have the balance sheet, we're going to have a lease receivable. We're going to debit that, and we're going to have a debit balance in our lease receivable. We're going to have an amount there. And then we're going to have a contra account called unearned interest income. Okay, so unearned interest income is a contra account. And it's going to, if it's a contra account, it's going to be a credit balance. It's going to bring down your lease receivable to, this is called the net investment. Or otherwise, it's the present value of your lease receivable. Okay, so it's the present value amount. So your lease receivable is going to be all your lease payments not at present value, but if you get rid of this unearned interest income, it's going to give you the present value amount. Now, and it's also just, when you're doing this journal entry, it's your balancing figure. Okay, so you would get it by your balancing figure. It's the easiest way to figure that out. All right. So that's the first journal. That's the journal entries you do at the inception of the lease. The next journal entry you would do is every time there is a cash payment date, we would debit cash, credit lease receivable. Just like if you got any other receivable, you would debit your cash and get rid of your receivable. So every year we're gonna get rid of some of the lease receivable. And then at year end, we have to do a journal entry to update the present value, right? So just like we did the interest expense entry for the leasee, we're going to be doing an interest income entry for the lessor, okay? And to determine that, we could do an amortization table. So same type of way, same way we did the interest expense for the lessee, we're going to do it for the lessor. But now it's interest income instead of interest expense. For direct financing or finance lease, so again, IFRS and ASPE, same journal entries for sales type or manufacturer dealer or direct financing finance lease. So the journal entries don't change whether you're in ASPE and IFRS. All right, so as direct financing or finance lease means that the company purchased an asset and then leased it out. And they purchased the asset in order to be in the intention of leasing it out. So a first journal entry would be the purchase of the asset. So you'd write equipment acquired for lease. And this is just to show the users of your financial statements that this equipment is not equipment that's going to be used by the company. It's bought in order to lease it out. And then credit cash. And you would have bought this at the fair value amount, right? So fair value of the asset would be that amount. And at the inception of the lease, we're going to get rid of the equipment that we just bought, fair value of the asset, and we're going to set up this lease receivable, which is the same way as your total lease payments. So same way we calculate it in the manufacturer dealer lease. So total lease payments plus residual value, any residual value, guaranteed or unguaranteed, and plus a bargain purchase, any bargain purchase option. And then you're going to have this unearned interest income that's going to be your balancing figure, but it's also going to be the difference between the fair value. It's going to be your, the difference between your gross investment, which is your lease receivable. So the lease receivable is your gross investment. And then your net investment is your PV. So this figure in unearned interest income is the difference between your gross investment minus your net investment. Okay, so it just basically brings your lease receivable to its present value amount. All right, so now let's keep going for question 1. So we figured out that that was a sales type lease. So now we can do the journal entries. Sorry, just one more slide here before that. The journal entries for the direct financing or finance lease moving forward, lease payment date and year end are the same as a manufacturer or sales type lease, right? So lease payment date, debit cash, credit lease receivable. At year end, we're going to use the amortization table to figure out what our unearned interest income and interest income entry is. All right, so now let's go and do part B, C, and D of question 1. Okay, so we already figured out it's a sales type lease. Part B is asking us to calculate the gross and net investment at the inception of the lease, and then prepare an amortization schedule over the 5 years. And then we're going to do the journal entries for 2017, 18, 19, and the accounting period ends December 31st. Okay, so our lease started August 1st, but December 31st is our year end. So you want to make sure you note that down when you're recording the journal entries for your interest income. All right, so pause this video, do these questions, and then you can unpause it and see if you did it correctly. All right, so let's take this up. So what is the gross and net investment? So the gross investment, like I said, that's the lease receivable amount. So it's a total of basically all the money that the lessor is going to receive. Okay, so they get $22,066 for 5 years. So 20,066 times 5. And then we're also going to add this 4,500. Okay. So if you just look at the gross investment, so I can just show you how to get it. So 20,000, and let's actually just bring it up from here. So it's 20,066 times 5 because it's 5 years. And then we're also times 5 plus our bargain purchase option of 4,500. Okay, so that's how we get this 104,831. So total amount that you're going to get. The net investment, like I said, was a present value amount. So we've already calculated the present value up here. So it's the 88,000. The difference between these two are going to be your unearned interest income at the beginning of the lease. Part C asks us to do the lessor's amortization table. So you're going to do that the same way as you would have done it for the leasee. So the net lease receivable is your present value amount. So you start off with the present value amount of 88,000 on August 1st. August 1st, you also get a payment of 20,000. No interest on the first day of the lease. So you're just reducing your balance, your lease receivable balance, down to 67,000. The next year you're paying, you're getting 20,000. Your interest is going to be your 9% times the whatever the balance was, the last balance on the lease receivable, so 67,000. And then you take the 20,000 minus the 6,000, that gets you the 13,952. 67,000 minus 13,952 gives us 53. Okay, you keep going down. At the end of the lease, you're going to receive the bargain purchase option amount of 4,500. And there's just a little rounding issue here, but basically this should be 0 or close, maybe just a couple cents off just for rounding. So there's your amortization table. And then part D says journal entries. So journal entries for 2017, 18, and 19. So we'll start off August 1st, 2017, the inception of the lease. So I just did the cost of goods sold and inventory entry together with the first journal entry for the inception of the lease. So you can do it separately like I showed you in the slides, or you can do it together. So it's the same amount. Okay, so the 60,000 here is your lessor's cost. So if you look at the question, lessor's cost is 60,000. We've already calculated what our gross investment is, 104,831. So the gross investment is your lease receivable, okay? 104. So that's your total of all your lease payments, plus any bargain purchase, plus any residual value. Okay? Cost of goods sold and inventory are the same amount. It's your 60,000 lesser cost. Sales revenue is your present value amount, which we've calculated at 88,000. And your unearned interest income is your balancing figure. Another way that you can figure out what your unearned interest income is if you notice, if you total up all your interest column, if you total it all up, you get 16,831, which is your balancing figure there. Another way you can figure out this unearned interest income is we've already figured out what our gross investment and net investment is. If you subtract these two, you will get 16,831. Okay, so a couple of different ways to make sure that amount is correct. So that's the first date, the inception of the lease. What else happens August 1st is that you receive cash of $20,000. So the first lease payment. So debit cash, credit lease receivable, 20,066. And then December 31st, you have this unearned interest income. So that's going to come from your amortization table. The interest income in total is 6,114, but that's from August 31st, 2017 to August 31st, 2018. So that's for the full year. We want to do the journal entries at year end, which is December. So if you count the months from August to December, that's going to give you 5 months. So you're going to take the 6,114 times 5 over 12 to only record 5 months worth, which gives you 25,4752. Okay, so make sure you're keeping track of what is the first date of the lease and what is your year end, and only including the interest income from the first day up to year end. Then in August 1st, 2018, again, we're going to have an entry to record the 20 grand. Okay, so debit cash, credit lease receivable, 20 grand. We're going to also record the rest of that interest. So we had 2547 of the 6114. We're going to record the rest of that on August 1st as well. Okay, so the other 7 months basically. Okay, so unearned interest income, that's your 6114 minus your 2547. So we're basically recording that twice, like you're splitting it up and recording it separately. because of the year end date is different from the lease inception date. And then December 31st, 2018, debit earned under interest income, credit interest income, and that's only for 5 months. So we go over to our next one, 4858 times 5 over 12. Okay. And then you keep doing that. In 2019, we'll have this cash lease receivable entry, and then unearned interest income for the remainder. So out of this 4,858, we recorded, where are we? We recorded 2024 at the end of December, so we have to record the whatever is remaining. So 2834. And then at the end of 2019, we'll record our next one. So this 3489 times 5 over 12. Okay, then you just kind of keep doing that until we get to the end. Another thing that can complicate this question is if we had any exploratory cost that the lessee is also responsible for. Okay, so if it said instead of paying 20,066, they're paying 21,066 because $1,000 is insurance. You would have insurance expense credit here of $1,000. Okay, so if the lessee was paying cash, the annual lease payments were 21,066, but $1,000 of that related to insurance expense, then that you would just credit insurance expense here because the lessee is paying for that, not the lessor. So like the lessor kind of gets a credit on that expense. All right, so I hope that it made sense for a sales type lease. The last concept I want to talk about was a sale and leaseback. So a sale and leaseback is a transaction where a property owner sells a property to another party and then immediately leases it back from the new owner. So what they're doing is they're selling a property but then leasing it back. So essentially the seller ends up becoming the lessee and the buyer purchaser ends up becoming the lessor. The reason that a company might do this is maybe they need some money really fast. They still need to use their building, but they also need money right away, like up front. So they might sell their building, get the cash up front, but lease out the building from the purchaser. And for that, the annual lease, like the lease payments will probably happen every year, every month. So you get a big influx of cash, but you don't have to pay that off all at once, right? So usually what happens is the lease purchase and sale agreement and lease agreement are signed on the same day. So the buyer knows that I'm buying this asset to lease it back out. When we come to the journal entries for a sale and leaseback, under ASPE, we're going to have 2 extra journal entries for the lessee. So we're going to have a sale of the asset entry. Okay, so basically any sale of asset entry is going to be similar. So we're going to have our cash, right? So debit the cash for the amount of money that you're going to get. If it's a building, for example, we're going to get, or actually any of the assets will have accumulated depreciation. So if it's your asset, you're also going to debit your accumulated depreciation. So you're doing the sale entry just like you would any other sale of an asset entry. You're going to credit your asset, get rid of your asset off your books. Okay. And then you usually have a gain or a loss. ASPE says that if you have any gain, if there's a profit on doing this, the gain cannot be recorded right away. It has to be deferred and recognized over the lease term. So you would depreciate the gain over the lease term, basically. So instead of having a gain, we're going to have a deferred gain. Okay, so if you have a gain, you can't record that gain right away. We have to defer it, and we're going to recognize it over the lease term. So little by little over the lease term on a straight line basis. If there is a loss, so if you do this and you get a loss, but the fair value is less than the carrying amount, then the loss can be recognized immediately. So a gain has to be deferred, but if it's loss, the loss can be recognized immediately. So you wouldn't have to defer a loss, but you have to defer a gain. And that's because accounting is conservative, so we don't really like recording gains, but recording losses is okay. So this is the would be the first journal entry for the leasee. Then the leasee would determine whether it's a capital or operating lease, and then do the journal entries for capital lease or operating lease. The other journal entry that would be added for the leasee is recognizing that deferred gain over the lease term. The way that you would record this, so you credited the deferred gain, and then each year you can recognize a part of it. So you can recognize deferred gain, debit, and since you're amortizing the gain, we could put this in depreciation expense credit. So you can credit this in depreciation expense. So each year, if there's a $10,000 gain and the lease term is 5 years, each year you would do this journal entry for $2,000. With the lessor, what the lessor is going to do is the lessor is going to go through the criteria for the lease and determine how to record this. So it's either going to be an operating lease or a direct finance lease, depending on how the criteria works out. It can't be a sales type lease because they did not manufacture this asset. Right? A sales type lease is when the company manufactures the asset and leases it out. This is them buying the asset, then leasing it out. So it's either going to be operating lease if the criteria are not met, or a direct finance lease. And there's a journal entries that I just wrote up. So if you can't read my writing, then you can see so deferred profit on sale back is what the official wording ASPE uses. And the entry to record the deferred profit, debit deferred profit or deferred gain, credit depreciation expense. For IFRS, it gets a little bit more complicated. For IFRS, you first have to determine if the transfer, so the sale, whether the sale meets the criteria under IFRS 15 revenue recognition. Okay, so the first thing is to go through the revenue recognition rules to determine does it actually meet the criteria of a sale. If it does not meet the criteria for a sale, okay, so if it does not meet the criteria of a sale, then we have no sale or purchase recognized. Instead, the amount that's received by the seller and who becomes the leasee, that's recorded as a financial liability. And the person that gets the money, the buyer/lessor, records this as a financial asset. If the transfer does meet the criteria of a sale, but the sales price is greater than the fair value of the asset, then the difference is going to go into a financial asset and a financial liability like this. Okay, so if the sales price is equal to the fair value, then we do the same thing as we did in ASPE. If the sales price is greater than the fair value, then the amount over the sales price would have to go into a financial liability for the lessee and a financial asset for the lessor. When you're doing the right of use asset calculation for the leasee, so this is for the leasee, it's a little bit more complicated if the sales price is greater than the fair value. You're going to take the carrying amount of the asset, so in this case I said building, divided by the fair value amount of the building, multiplied by the present value of the minimum lease payments that you would have calculated. The lease liability is the PV of the minimum lease payments. You're also going to have a gain or loss here. The gain or loss will be your balancing figure. So when you do that journal entry where you have this cash accumulated asset deferred profit, like within this journal entry, you would also set up a right to use asset, set up your liability, and then your profit will be the balancing figure. And so you're gonna, you might have a financial liability set up in there. Okay. The textbook has a good example of this and shows you all the journal entries and everything. So you can go through the example of how this is calculated and take a look at that. They have a good example in chapter 20 for that. All right, so let's look at question 2. Question 2 on your Excel. So on January 1st, this company sells equipment for $720,000 and immediately leases it back. Both the companies use ASPE. And then we have a bunch of other information here. Carrying amount is $640. It's a 10-year term. Title will transfer to Heen at the end of the lease. So Heen is the leasee. The payments each year at the end of each year are $117,176. The incremental borrowing rate of the leasee is 12%. The borrowing rate of the lessor is 10%. Equipment has a fair value of $720,000. Economic life of 10 years. No residual value, and Heen pays executory cost of $11,000 directly to the appropriate third parties. So the $11,000 is not included in the 117. So questions are: determine the type of lease for the leasee and the journal entries for the leasee for the sale and lease back, including an amortization table. And then part B is figure out the type of lease for the lessor, journal entries for the lessor, and it's saying that no uncertainties exist and collectability is reasonably certain. All right, so what I'd like you to do now is pause this video, try this question, and then when you are done, come back to this video and watch the take up. Okay, so let's take this up. So part A, we're looking at the leasee. We need to know what type of lease it is first, and then the journal entries. So again, we start off with the transfer of ownership test. Yes, because there's an automatic transfer. So it says here, it tells us here that title will transfer to Heen at the end of the lease. Okay? So I would just copy that over just to show that, that this is why at the end of the lease. Okay. Okay, sorry, it's not showing up. Okay, oh, that's because I didn't fully copy it. All right, title will transfer to Heen at the end of the lease. So yes, this does have a transfer of ownership. Economic life test, we're going to take our 10 years lease term divided by the economic life, which is also 10 years. So we have 100% there. So 10 divided by 10 equals 100%, which is greater than 75%. So yes. And then the investment recovery test we need to do last, which we're going to do the present value. So I can do the present value up here to show you. So equals PV. We have the rate. So this is ASPE. ASPE uses the lower of the lessor rate and leasee rate. So we're going to use the lessor rate, which is 10% because it's lower than the 12. Number of periods, we have 10. The PMT, we have here 117, 176. Future value. So it says there's a residual value of 0. And it doesn't show a bargain purchase option, so we don't actually have a future value here. And then it says the payments are happening at the end of each year. If you see here, number 3, lease agreement requires equal payments of 117, 176 at the end of each year. Okay, so we're going to use 0. All right, so we have a present value of 100, so we can round this to 720,000. Okay. So our present value is 720. We're going to divide that by the fair value, which is also 720. So that's 100%, which is greater greater than 90%. So yes, this criteria has been met. So all three criteria have been met. So, I'll actually write since all three criteria have been met. Since all three criteria are met, this is a capital lease for the leasee. So now we can do an amortization table before we do our journal entries, because we'll need our amortization table. So start off with your present value amount. In this case, our annual lease payments are at the end of the year, and interest will be charged at interest. You'll have interest at the end of the year as well. So December 31st, 2017, we can do the full row for our amortization table. We couldn't do that in the last question because the lease payments were at the beginning of the year. So lease payments were at, well, the first lease payment was at a different date than when your interest is. But here, they're both happening at year end. The lease inception date is January 1st. Year end is December 31st. So that works out well for us. We don't have to worry about trying to figure out. I didn't put the year end date for the year. So assume that here the year end is December 31st. Okay, so you do your amortization table. Again, payment interest is 720 times our 10%. This column minus this column, 45,000 minus 720. Okay, so you keep doing that for all the 10 years, and we should have something very close to zero. Journal entries for the first year. The first journal entry is your sale. So you're pretending like you sold the, well, you did sell the asset, sorry. So you sold the asset. So how much cash did you get? So it says Kiran Corporation sells equipment to Liquidity Finance Corp for 720. So that's the cash. Equipment carrying amount is 640. So it doesn't tell us what the depreciation is separate from what the cost of the equipment is. It just gives us the carrying amount. So we can just get rid of the 640 and don't have to separate it because we don't have that information. So if we got 720 and our carrying amount is 640, that means there is a gain of 80,000. We can't record that gain right away. We have to defer it. So we're gonna have a deferred profit on sale leaseback of 80,000. Then at January 1st, we also do the journal entry for the inception of the lease. We're going to set up our asset and our liability, and that's going to be our present value amount, which is 720. And then the end of the year, in this example, at the end of the year, we're doing our lease payment plus we'll record our interest expense. So in all the other questions, we had our lease payment at the beginning of the year. In this question, we have our lease payment at the end of the year. So I basically did the interest expense and lease payment entry together. You can do it separately if you want. So the cash is 117,176. The interest expense for the first year is 72,000. So 72,000, and then the balancing figure would be this 45. You could do this separately. You could debit lease obligation 117, credit cash 117. Then the other entry would be debit interest expense 72,000, credit lease obligation 72,000. Okay, either way, it's fine. Another thing that happens December 31st is the companies, so the question said that Heen pays executory cost of 11,000 directly to the appropriate third parties. So this could be insurance, for example. So we can do the journal entry for that too. Like so operating expense or insurance expense, we don't know what the expense is, so we could just call it operating expense. And you can choose either cash, accounts payable, or cash, 11,000. We also have our depreciation entry for our leasee. Remember, we recorded this leased asset, so we have to depreciate that. And if you remember from the last video, I had a chart for the depreciation. So if the asset is going to be transferred to the leasee at the end of the lease term, we're going to use the economic life to depreciate the asset. So the economic life is 10 years. we have no residual value, so we don't have to deduct any residual value there. So basically our asset amount, 720, divided by our economic life of 10, which is 72,000. And then the last thing here, because it's a sale and lease back, we have to defer our profit. So we deferred our 80, we have to defer 80,000 and we can record it over the lease term. So 80,000, we have a 10-year lease term. So we're going to recognize that 8,000 each year. So we'll do the same journal entry each year of 8,000. Actually, these 3 journal entries, we're going to do the same over and over again every year. Just your interest expense is going to change each year because of your amortization table. All right, so that was part A. So that was a long part A. Part B says determine the type of lease for the lessor and prepare the journal entries for the lessor for 2017. All right, so for the lessor, first thing we have to figure out is this a capital lease for the leasee? So that's the first thing. So going through all these 3 criteria, we've already done that. We already know that, yes, this is a capital lease for the leasee. So is it a capital lease for the leasee? I'm just going to write yes. So I'm going to write yes and then C above. And then we have to go through those 2 extra criteria. So is the credit risk reasonable or normal? It told us here no uncertainties exist and collectability is reasonably certain. So yes, it is reasonable and it's normal. Collectability is reasonably assured. Are there any unreimbursable costs that are reasonably estimated? Well, it says that there's no uncertainties. So yes. Okay, so we have a yes, yes, yes. So we know that this is not an operating lease. That's either sales type or direct financing lease. So the last thing we have to do is figure out the lessor's cost versus the fair value of the asset. So the fair value it told us was 720. It doesn't specifically say the lessor's cost is this, but it says here that Hean Corporation sells equipment to Liquidity Finance Corp for 720. So if that's how much Liquidity Finance has to pay, then that's lessor's cost. So the lessor's cost is actually equal to the fair value. Therefore, this is a direct financing lease. All right. And then we just have to do the journal entries. We've already done the amortization table. This amortization table will work for the leasee and the lessor. So it's the same interest, okay? Because the balance is your present value amount, which we've already calculated. These are the payments. So the interest will be the same amount for the leasee and the lessor. The only time the interest will be different for the leasee and the lessor is if they use a different discount rate, because the lessor uses, the IFRS of, because I guess it depends on if it's IFRS or ASPE. ASPE says use the lower of the 2 rates, so it will actually be the same if they're both using ASPE. So if the lessor is using IFRS and the leasee is using ASPE, then there might be a difference in the rate. But otherwise, this question, they're both using ASPE. Right? So we know it's a direct financing lease, so we can do the journal entries now. First journal entry is the purchase of the equipment. So the purchase entry on January 1st. Okay, so we're going to debit equipment 720 and credit cash 720. Second journal entry on the same date is setting up the lease. So we're going to get rid of this equipment. We're going to debit our lease receivable for the gross amount. All we have here is the lease payments of 117,176 times 10 years. Okay, so that's what that is. We have no residual value. We have no bargain purchase option, so we're not going to add those. And then we have unearned, so I called it unearned interest income, so I should just call it unearned interest income instead of unearned revenue. Okay, so that's your balancing figure. Your equipment, you just kind of reverse this, so it's the same amount. Your lease receivable is the total of all your lease payments plus any residual value, any bargain purchase option. December 31st, we have a few entries to make. First is you're going to get the cash every year at the end of every year of 117, 176. So get rid of some of your receivable. And then you have to do your unearned interest income, unearned interest income. I just want to, sorry, I'm just going to write interest income just to keep it consistent with my slides. But yeah, unearned interest revenue is the same thing. It's fine. So this 72,000 is coming from your amortization table, 72,000 there. So it's the same as your interest expense when you were doing the, here, interest expense when you were doing the journal entries for the leasee, 72,000. All right, so I know there was a lot going on there. We had to do journal entries for both the leasee, lessor, and it was a sale and leaseback. So in sale and leaseback, or just a direct financing lease, there isn't a difference in the journal entries. But for the lessee, or because this is a sales-back lease, there is this extra journal entry here for the deferred profit and the extra journal entry at the beginning for the sale journal entry. Otherwise, the entries in the middle are all the same as just a regular lease on the leasee side. All right, thank you for listening. Hope you learned a lot. Take care and see you next time.